This is Scott Becker with the Becker Private Equity Podcast. Thrilled today to be joined by Matt Wolf. Matt's a senior leader at RSM and one of our listened to guests. He's going to talk to us today on a few trends that he's watching in the private credit area. Matt, let me tee it up and ask you to take it away. What are some of the things that are top of mind in private credit?
Yeah, thanks for having me on, Scott. It's been really interesting to watch some of these asset allocations change, and specifically with private credit. Over the past couple of years, there's been this rush of new funds, LPs allocating more money to private credit, presumably, in many cases because private equity returns have been a little more muted, and we're starting to see some of those chickens come home to roosts, just in terms of compressed spreads for a lot of those private credit funds. And we've seen funds have to sort of go down market, maybe look at deals they maybe hadn't looked at before, take a little bit more risk as they try to, not all funds, but some, right, as they try to generate the returns that they need to generate for their LPs, again, as the market becomes really saturated. And we see the cycles in various corners of asset management, right, over time. It's just part of the normal business cycle. And as this starts to work out, it'll be interesting to watch too, because what I think we'll see is we'll see some funds get a little more creative, maybe with some of the sources of their financing. We saw some of the bigger players actually issue bonds that they've used to raise capital to then lend in the private markets, to very small mid-market or micro-cap companies. We'll see increased specialization among private credit funds, right? It focused by industry or sector, subsector type thesis, aside from just sort of a typical deal size, as again the market sort of orients and reshifts itself as these private credit funds and sponsors seek to generate the returns that they need for their LPs as the market becomes much more crowded. So it's part of this cycle. It's been interesting to watch. It's not going to resolve itself in a day. It'll shake out over time, and it'll be really interesting to see what that does for deal volume and just sort of capital allocation over the next 3 to 5 years.
And one of the things you point to, which I think is so fascinating, there'll be another take on what you're talking about, is the huge pension and endowment funds tend to start to make something a core allocation after that area has already become hot for several years. So what we saw was, if I go back a few years ago, big endowments, big pension funds, all of a sudden up their allocations to private equity and venture capital. And that was sort of at a time past when venture capital and private equity had already totally exploded. And then they were chasing situations. And here you have private credit, which has been so hot the last 5 to 10 years. And now you've got the coming of age, big endowments, big pension funds, making it a bigger and core part of their allocation at a time when you're already maybe past one core growth cycle. That doesn't mean that it doesn't make sense for the long run, but it is fascinating to see some of these huge endowment funds play catch up as the world changes more quickly than they do. And that's not right or wrong, just an observation. Any thoughts on that?
Yeah, absolutely. We see that kind of play out as a function of different risk profiles, right? So as you mentioned, the larger funds, the endowment funds, insurance companies, they were slower to be LPs and venture capital for funds than were some other sponsors, and they have a lower risk tolerance, different risk reward sort of metrics, and that makes sense that they would come later. It was sort of like it's analogous, right, to like the joke around like Bitcoin retail investors. They said, oh man, my uncles were talking about Bitcoin at Thanksgiving. It's time to get out. It's the height, right? As different entrants enter the marketplace there. It's as you said, it's just part of that cycle. People, whether they're retail investors or large sophisticated endowment funds, have different risk profiles. They're going to enter into these asset classes at different times. And you're absolutely right. It is a big driver of this of this squeeze, and it will push this sort of shakeout amongst private credit firms. And they will have to figure out how they're going to specialize, how they're going to change their operational models to continue to attract capital and then deploy it in ways that generate meaningful returns.
Yes, I think the analogy to your uncle and Bitcoin, and not your uncle particularly, is so similar to one that's been made over the years about lawyers, doctors, accountants, is when they leave the professional trades to go into the new business. That means that new business has already passed the cusp of its sort of like height, and they've hit it late because it's not until it's at that spot that they do it. It's like the uncle jumping into Bitcoin after all the cool kids had done it 15 years ago, or the cool nephews. I think it's a fascinating analog, and it's fascinating for me to see the pension funds, the endowment funds chasing the private credit, which has been talked about for years. We're at the spot where rumor has it one of the private debt funds that we happen to know well is rumored to be potentially for sale for some insane dollars. And it's at that time in the cycle when the people that drove a lot of these things start to think, oh my goodness, I better cash out some of this before the business gets tougher. And what happens too is, yes, the pension funds and big endowment funds have mandates to fund a percentage in this. At some point, you end up with a supply and demand imbalance where there's so much money chasing those areas, and there's not enough deals for those funds to do. And then it becomes exactly what you're talking about. The margins get tighter and tighter. The credit risk becomes a little bit higher, and so forth. And the margins get tighter, and it's really interesting.
Absolutely. The other sort of corollary to this is that we've seen some very big players, big names come out and try to warn about how private credit is this systemic risk to the economy. I don't see it. I don't understand. It's not close to the same as what we were in, like the run up to the global financial crisis, for example, and how it works within the economy. And I think a lot of that concern, and maybe I'll be proven wrong, and I hope not, but maybe it is a systemic risk to the economy. But I think a lot of that pushback is potentially reactionary or defensive from folks who feel like maybe they missed the boat, right? And they missed the wave. They see that it's high, and they need to talk about why they didn't latch on.
And it also often becomes the people that are in the debt business now competing with the more aggressive private debt people, trying to paint them as a negative in that narrative. My debt is good.
Absolutely.
That debt is too risky and creates more trouble for the economy.
Absolutely. We saw similar dynamics in the early and mid 80s with the onset of private equity and junk bonds in the beginning, right? It was a similar dynamic.
And then one other question, Matt, we've seen sort of a little bit of the bolt-on deal concept is in everybody's private equity playbook. It does seem like there's one bit of slowness in that now as people have taken on a lot of deals. Some of them have not gone as people expected. The debt levels are higher on some of these companies than expected. What's your take on that? What's your sense of the deal market, the bolt-on market, and what do you see out there?
Yeah, I think the traditional kind of platform plus bolt-on playbook is largely dead. We certainly still see some variations of those strategies. However, with the sort of debt discipline and debt constraints, financing constraints that you just mentioned, what a lot of sponsors are doing is they're saying, okay, well, if we're going to bolt on a company, we have to access every single operational efficiency that we possibly can, which means we are going to integrate their technology into our technology. We're going to be aggressive about that, where in the past, that wasn't always the case, right? A lot of these add-on acquisition strategies were saying, well, you come over, you stay on your systems, we'll be on ours, we'll operate under the same brand name, and it'll be great. We'll sell this thing in 4 years and make lots of money. And that can't happen anymore. And so what that means, though, is a lot of sponsors are looking at that and saying, well, gosh, do I buy the bolt-on, which I'm going to have to spend a bunch of money to integrate all the technology? I probably won't be able to finance it at the rates I want to finance it at. It's going to be a big equity check anyway. Do I do that? Or do I just start a de novo growth? Do I expand into this geography or into this market and build it myself? So the debt dynamic has changed that build versus buy analysis significantly. Whereas in the past, it was so much cheaper just to buy. Going forward, for a lot of sponsors and a lot of markets and a lot of industries, it's just going to make more sense to execute on de novo growth, and mostly through the equity financing or cash flow from the existing business financing that new de novo growth.
No, that's absolutely fascinating. Your point on that as well. People look more at the closer to the build versus buy. We know that build has more risk often. It takes longer in terms of getting to successful business, but it has lower risk in terms of the debt component. I think your point on that is right on. Matt, I want to thank you as always for joining us on the Becker Private Equity Podcast. It is great to visit with you. Thank you for joining us.
Thank you, Scott.